So for this session, we are to talk about your compound financial instrument and your debt restructuring. Now, for compound financial instrument and debt restructuring, what is important here is, of course, your knowledge before in your present value factors, because once you know how to discount, this would be easier for you, especially in compound financial instruments. While in your debt restructuring, there's not much to be known as to the rules because they are easy to follow. Unlike before, when you learned in your asset section regarding your compound financial instruments in case you have investments, those investments are either accounted split or non-split. And it depends again on our standard. And if you remember your compound financial instruments under your asset section, we do not really have a specific guidance on what do we do with your compound financial instruments. However, for your compound financial instruments under your liability section, we have a specific guidance. So later you will see or you will know what is that specific guidance. Next, on your debt restructuring, if ever before you remember on your asset portion, you have your what do we call this one, impairment of your assets. And in impairing your assets, you look on your future cash flows. Now on the part of the debtor, so liability side, on the part of the debtor, that particular change as to the terms on the payment of the liability is called debt restructuring. So you will see later the differences between your accounting under the asset section and your accounting here in your liability section. Let's start first with your compound financial instrument. So what is a compound financial instrument? So compound financial instruments are financial instruments that have both a liability and equity component. So instead of only one, so if instead of only one, so it's either liability for investment in bonds and for equity that is either investment in equity securities. Okay. So instead of only one investment, a particular company issues a compound instrument. And that compound instrument contains both liability and equity section. Now, before, as I told you in our introduction, this liability and equity portion before in your asset section is dependent on our guidance, whether we will split them or we will not split them. However, for your liability portion, the accounting is that we will use your split accounting. So one financial instrument, it should be accounted split, meaning you will account both items. That is the liability portion and your equity portion. That is on the part of IA2. If you remember in your IA1, if we have one financial instrument and that is considered as a compound financial instrument, the guidance is not yet clear. But here in IA2, the guidance is clear. We use your split accounting. So when we say split accounting, we do your with and without method or your residual approach. Sir, what is this with and without method? With and without method or residual approach. So in this with or without method or residual approach, first we get for the total issue price. Then out of your total issue price, we deduct the present value of the liability portion. That's why it's called residual approach. Any residual, any residual is given to your equity portion. Okay? So again, in the accounting of your compound financial instrument, what we do is we get out of your total issue price the fair value or the present value of the liability. And whatever is the residual, that is for your equity. That's why it's called with and without and your residual approach. So again, your split accounting under your compound financial instruments for your liabilities is called with and without method or residual approach. Now, when we talk about your compound financial instruments, in IA2, we have two compound financial instruments. First, of course, is your convertible bonds. A convertible bonds is, of course, a bond liability with an with a conversion option. So when we say a liability with a conversion option, you can exercise that particular conversion or you will not exercise that particular conversion. So during the lifetime of the bond, you have the right to convert it. Okay, so you have the right to convert it. However, it is not considered it is not considered an obligation on the part of the bondholder to always convert it. So that is still an option to the bondholder. So it's either you convert it or you don't convert it. Second, we have your bonds with detachable warrants. Okay. So when you're bonds with detachable warrants, here you have two instruments really. You have bonds and you have detachable warrants. So they are separate with each other. While in your convertible bonds, the equity portion is embedded in the convertible bonds. In the second one, the detachable warrants is not embedded on the bonds. So even if you will retire the bonds, or even if you will uh, convert the bonds, walang mangyayari. Andyan pa rin yung detachable warrants. Okay? So we will talk about your compound financial instrument, primarily your convertible bonds and your bonds without detachable warrants. Remember, we use split accounting. Out of the issue price or the total proceeds, we split our liability and equity portion. So let's start now with your convertible bonds. So what is a convertible bond again? Are bonds that give the holder to convert the bonds during its lifetime. So if you have bonds, during the term of the bonds, you can convert it to equity. You can convert it to equity. Okay. So we have three main problems or three main issues as to the accounting of our convertible bonds. That is on the issuance, the conversion, and or your retirement. Remember, you have either the choice if you convert it or you retire it. Okay? It's either you convert it or you retire it. So first we go with your issuance. So on the issuance, of course, what will we do? Is split accounting. The liability and the equity portions will be recognized. Aside from that, guys, we should now recognize, of course, any discount or premium out of your liability. Sir, how do we compute for our premium and discount? So, 'di ba, initially, to compute for your equity portion, that is equal to your proceeds or your issue price less your present value of liability, that is your equity portion or equity component. Now, to compute for your discount or premium is equal to your face amount versus the present value of liability. So in your issuance, what are the items that you will recognize? Of course, your liability together with its discount and premium. And aside for that, you recognize your equity. Sir, what do we call the equity component in a convertible bond? The equity component in a convertible bond is known as share premium conversion. The equity component in a convertible bond is known as share premium conversion. Again, on your issuance, what are the items you need to recognize? You recognize the liability together with its discount and premium. And aside from that, you recognize the equity that is your share premium conversion. Now we go to your transactions after the issuance. That is either conversion or retirement. So if you convert it, your amounts initially recognized are transferred to equity. So in short, all of these items are transferred to equity. So meaning the converted equity, the value of this converted equity is the total book value of your liability and your equity portion. So when we say converted equity, that is already the share capital together with the share premium. So the converted equity now, since because of the conversion, the share capital and your share premium, the amount that you will transfer here is the total book value of the liability and equity initially recognized. Okay. So initially, you recognize these two items, right? Now you will convert it. If you will convert it, whatever is the book value at the time of conversion will only be transferred to equity. When we talk about your equity, that is your converted equity, share premium, and your share capital. Take note, guys, that share capital should always be recorded at par, and any excess of the value is your share premium. Okay? In case you will convert. But what if you will retire? If you will retire, you will compare the retirement price, the fair value of your bond, and your carrying amount of your bond. And you have your different gains or losses. Take note, the gain or loss is only computed using your fair value of bond and your carrying amount of bond. While for fair value versus your retirement price, this is your extra share premium or a reduction to your share premium conversion or retained earnings. Sir, why is it share premium conversion and retained earnings? So as you can see, if the fair value is lesser than your retirement price, then you charge it to first share premium conversion, meaning up to the extent of your share premium conversion. We said a while back that in our split, the equity portion is known as share premium conversion. So you have only a little amount of share premium conversion, let's say. And once you will retire it, if the share premium conversion is not enough, what will happen? If the share premium conversion is not enough, you charge to retained earnings. You charge to retained earnings. Next, as the fair value and the carrying amount of the bond, if the fair value is greater than your carrying amount, we have a loss. If the fair value is lesser than your carrying amount, we have a gain. Okay, why? Because our carrying amount, again, is the liability. Take note, we are settling a liability. Of course, what we want is that if we settle it lesser than the carrying amount. So every time there is less than, that is gain. Okay? When we settle a liability, what do we want? We settle it at a lesser amount than the carrying amount. So every time there is a less, there is a gain. There is a gain. So to compute for your gain or loss again, what you need to take note, if it's less, then it's a gain. If it's more, then it's a loss. Okay? On your gain or loss. Let's have an example of your convertible bonds. On January 1, 2017, Monk Company issued 20,000 convertible bonds. The 6% bonds has a 5-year term and were issued at 112. Each of the 1,000 value band is convertible into 100 ordinary shares of Monk Company, whose par value was 5. When the bonds were issued, the prevailing market rate for a similar debt instrument without conversion feature is 8%. On January 1, 2019, bondholders exercised their conversion option. 12,000 were converted when the prevailing market price of Monk Company's ordinary shares was 10.8. Okay, so first is split accounting. So in getting for your accounting issue price less the present value of your liability. So what is our issue price? The 20,000 convertible bonds with 1,000 face value were issued at 112. So this is 20,000 multiplied by 1,000 face value multiplied by 112%. So how much is our issue price? 20,000 times 1,000 times 112%. This is 22,400,000. Next, for the PV of liability, so we need to get for the PV of principal and the PV of interest. For our PV of principal, that is 20 million, right? 20,000 times 1,000 is 20 million. We use PV of 1. Of course, N is equal to 5. I is equal to 8% because that is the prevailing market rate. Now, PV of interest. So our interest is 6%, 20 million times 6%. So we need to use your PV of ordinary annuity of 1. N is equal to 5. I is equal to 8%. How much then will we get here? Okay, let's compute. Okay, did you get 18 million? 18,402,916. Okay, that's in case you got the present value as a whole. Okay, now after that, after getting the issuance price and your present value of liability, we have your equity portion. So what is your equity portion? 22.4 million. And we have your 18,402,916. So we have 3,997,084. Okay. So out of 22.4, how much is for liability? 18,402. So in answering letter A, our answer is 18,402,916. Next, the amount of premium or discount. For premium or discount, you just compare it to your face amount. Your face amount is 20 million. The present value is 18,402,916. So 20 million less 18,402,916 will give us 1,597,084. 1,597,084. Next, for equity portion, we have already computed that 3,997,084. Now, for interest expense, of course, the same. Whatever you have learned before in your bands, you will still use it. So if the question is interest expense, that is equal to your initial measurement, that is 18,402,916. You multiply it to your effective interest rate of 8%. So 18,402,916 times 8% will give us 1,472,233.28. Next, carrying value of the bond liability on December 31, 2018. So for carrying value, you just need to amortize it for 2 years. Kasi nga, 2017 to, December 31, 2018 to. So let's amortize our band for 2 years. Okay. So upon amortization of 2 years, we will get 18,969,161.22. So I hope when I say amortize it for 2 years, you already know how to amortize. I hope I do not need to show you how we calculated 18,969,161.22. Why again we need to amortize for 2 years, 2017 and 2018, because this is January 1, 2017, this is December 31, 2018. Next, the share premium arising from the conversion. So if ever we are to convert, what did we say? So the amount previously recognized will now be transferred. The amount that previously recognized will now be transferred to your equity. So what is the amount previously recognized? That is your liability and your equity. So for your liability, what is the value of our liability as of December 31, 2018? That is 18,969,161.22. And then we have also the value of your equity portion. What is the initial amount of our equity portion? That is 3,997,084. 3,997,084. So how much is our total amount? 18,969,161.22 plus 3,997,084. Our total value is 22,966,245.22. Sir, why is our liability now 18,969? If we go back on our discussion a while back, we said the amount now will be transferred to equity. So what is the amount of the liability as of December 31, 2018 or January 1, 2019? Sir, why do we need to look at January 1, 2019? Because the January 1, 2019 is the exercise of your conversion option. If we try to exercise, remember this, if we try to exercise, what do? The total amount or total carrying amount will be transferred. What is the carrying amount of liability? We computed it. What is the carrying amount of the share premium conversion? 3997084. Remember this also. Only the liability is amortized. The share premium conversion will remain the same. So whatever is the share premium conversion, this is letter C, share premium conversion. Whatever is the share premium conversion in letter C will remain the same. So the total amount is 22,966,245.22. Now, it will be transferred to equity. Ilan daw yung na-transfer sa equity? 12,000 were converted. If we have 20,000 bonds and we have 12,000 converted, how much was converted? Total is 22,966,245.22. But since only 12,000 is converted, we get the proportion. So 22,966,245.22 times 12 over 20 will give us 13,779,747.13. Okay? 13,779,747.13. Okay. So in your 13,779,747.13, the converted equity now will be your share capital and your share premium. So for your share capital, first we need to get for the par value of the shares. What is the par value of the shares? 5 pesos. For each band, how much ordinary shares can be claimed? For each band, you have 100 ordinary shares. So 12,000 divided by 1,000 times 100. Okay? Sabi dyan, each of the 1,000 face value band is convertible to 100 ordinary shares. So how many bands did we convert? 12,000. So 12,000 divided by 1,000. So 12. How many shares can we get for each conversion? 100. Okay? So for each of the 1,000 face value band, we have 100 ordinary shares with par value of 5. So 12,000 bands divided by 1,000 times 100 shares. How many shares? 1,200 shares times 5. The par value is only 6,000. The par value is only 6,000. Therefore, our share premium is equal to 13,779,747.13 less 6,000. This will give us 13,773,747.13. Okay. So again, in your conversion, you transfer the amount to the equity. And here kasi, it is not the whole bands that is converted, only 12,000. So if ever it is 12,000, you prorate. And then after you prorate it, getting the value, you now allocate it to your share capital and your share premium. Share capital should always be at par. So our par value is 100 pesos. Our par value is 5 pesos. Our share is 100. And whatever is left is your share premium. Okay? Next, we go with your bands with detachable warrants. So with your bands with detachable warrants, what do we have here? These bands will always be accounted as a normal band, but what we have here is a band and a detachable warrant. Unlike in your convertible band, once converted or exercised, the band ceases to exist. Okay? In your convertible band, once exercised or converted, the band ceases to exist. However, here, the detachable warrants, once exercised, band will continue in existence. Okay? So, kanina, pag nag-exercise, mawawala yung band. Dito, pag nag-exercise, andun pa rin yung band. Okay? So, upon issuance, of course, your liability and equity portions are recognized. Upon exercise, the share warrants are transferred to equity. So what do we have here? The share warrants will only be transferred to equity. So upon exercise, you have two items to recognize. First, the transfer of share warrants to equity, and next is the purchase of your equity shares. Why, sir? The share warrants entitle you to purchase equity. Share warrants entitle you to purchase equity. What is the effect of that share warrants then? Once you will exercise them, the share warrants will be transferred to equity, and at the same time, there will be a purchase of your equity securities. So the total value of your equity will be from your share warrants and your purchase of equity securities. A while back in your convertible bonds, what do we call the share premium? Share premium conversion option. Here we call it share premium, share warrants outstanding. Now, we have your expiration. In your expiration, meaning the share warrants is not exercised. Sir, meaning the share warrants has a life? Yes. You can only exercise your share warrants within a certain period of time. If you cannot exercise it, then it is already expired. Once expired, you will transfer it to your share premium account. So what do? You remove share warrants outstanding. So share premium, share warrants outstanding, it will go to your share premium. Okay? Let's have an example. On January 1, 2017, Jim Company issued its 10% 5 million face value bonds with the maturity date of January 1, 2020 at 112. Each bond was issued with 50 detachable share warrants, each of while entitles the holder to purchase Jim Company's 5 par value ordinary shares at 24.75. The prevailing rate for similar bonds without warrants is 12%. Immediately after the issuance, the market value of the warrant is 5.25. So what do we do here? First, we get again the total issue price. That is 5 million face value and we issue it at 112. 5 million times 112 is 5.6 million. Next, we get for your present value of liability. To get for your present value of the liability, you just need to get for the prevailing market rate, that is 12%. So for the principal, we have present value of 1, N is equal to 2017, 2018, 2019, 3, I is equal to 12%. And for the interest, that is 5 million times 10%. We have OA, N is equal to 3, I is equal to 12%. So we need to get for the present value. Let's compute. So we have here 4,759,816.87. Whatever is left is the equity component. So 5.6 less 4,759,816.87 will give us 840,183.13. So the initial measurement of your bond liability, that is your liability components, 4,759,816.87. What is the premium or discount? For premium or discount, compare again the face value versus the present value. Face value is 5 million. This is 4,759,816.87. So 5 million less 4,759,816.57. So we have a discount of 240,183.13. And the initial measurement of your equity element, we have computed that at 840,183.13. 843,183.30. So in case guys that you will exercise it, sabi dyan, each band is issued with 50 detachable share warrants. So if we have 5 million bands and let's say 1,000 per band yan, how many bands? How many bands do we have? 5 million divided by 1,000 bands. So we have 5,000 bands. It is issued of 50 detachable warrants, so 50 warrants. Each warrant entitles the holder to purchase 5 par values. So 5,000 times 50. So we have 250,000. So at most, we can get 250,000 shares. If it is exercise, remember, we get for the exercise price. What is the exercise price? Sabi dyan, each of while entitles the purchase of Dream Company's 5 par value ordinary shares for 24.75. So we will now recognize the 24.75. We will recognize cash 24.75 times how many shares? 250,000 shares. So 6,187,500. The share capital should always be recorded at par. So that is 5 par value times 250,000 shares. 1,250,000. Whatever is left, share premium. So 6,187,500 less 1,250,000. We have 4,937,500. So that is the first that we will do. Kasi nga sabi natin, if it's converted, first, you need to record the conversion. Ayan. So first, we need to know how many shares was to be converted. And then second, you need to transfer the share premium, share warrants outstanding to your share premium account. So what is the share premium, share warrants outstanding? We have computed the equity at 840,183.13 and then share premium 840,183.13. So pag tinanong how much is the total share premium, ito ang sasagot ninyo. Pagsamahin nyo to at saka ito. Okay? So again, we go back. If there is a exercise of your detachable warrant, two items. With me, the share warrants is transferred to equity and we record the purchase of equity securities. So here we recorded first the purchase of equity securities and then subsequently we transferred to the equity the share warrants. So we're done with compound financial instruments. Let's go now to your debt restructuring. What is the debt restructuring? The debt restructuring is the process that allows entities facing cash flow problems and financial distress to reduce and renegotiate its delinquent debts in order to improve or restore liquidity and rehabilitate so that it can continue operations. So on the part of the asset, we call this one as impairment of liability. On the part of your liability, particularly IA2, we call that as your debt restructuring. So in your debt restructuring, four, four ways or there are four categories to affect your debt restructuring. So what are those four categories? We have your debt forgiveness, we have your asset swap, equity swap, and modification of terms. Let's start first with your debt forgiveness. In a debt forgiveness, the debt forgave is simply recognized as gain on extinguishment presented in profit or loss. So ano nangyari dito? Take note, we are the debtor here. So we have a liability. So the creditor forgave your liability. If the creditor forgave your liability, you just remove the liability and you credit gain on extinguishment. Okay? So for example, you have a liability. What is the, let's say, your liability is 6 million. Tapos sabi nung pinagkakautangan mo, okay lang, wag mo nang bayaran. Okay? So finorgive niya na lang. Anong gagawin mo? Debit liability, credit, gain on extinguishment. That is for debt forgiveness. Another is your asset swap. In your asset swap, you will transfer an asset to a particular creditor. What do we call this one? In your obligation, the Sean and Pago. The Sean and Pago. Anyway, we are not in obligation, but it's called the Tion and Pago. In your Dashon and Pago, the liability is extinguished by the delivery of your non-cash asset. So what do? You transfer your non-cash asset in payment of your liability. So in your asset swap, how do we compute for it? First, you get the carrying amount of liability. You deduct the carrying amount of the asset. Always at carrying amount, okay? The asset, is recorded at carrying amount, not on fair value. Take note of this. It is on your carrying amount. So a while back in your debt forgiveness, what happens? You will just forgive the liability, then it's done. But in your asset swap, you will pay first using an asset. So to get for your gain or loss on extinguishment, you compare the carrying amount of the asset to the carrying amount of your liability. Next, equity swap. In your equity swap, sa asset swap, anong pinambayad mo dun sa utang mo ng cash asset? Sa equity swap, ang papambayad mo naman ay equity instruments mo. So the liability is extinguished by issuing own securities. So to compute for your gain or loss, you get for the carrying amount of liability less the fair value of fair value of equity. That is your gain or loss. But in your fair value of equity, how do we measure it? To measure the fair value of your equity, we use your IFRIC 19. So if the fair value of equity is given, use the fair value of equity. If fair value of equity is not given, use the fair value of liability. If fair value of equity and fair value of liability is not given, carrying amount of liability. In the first and second, we have gain or loss. On the third one, there is no gain or loss. Take note of this. Guys, pagka equity swap, meron tayong hierarchy. Ano yung hierarchy natin? Fair value of equity, fair value of liability, and carrying amount of liability. Let's have an example. On January 1, 2017, Lu Company issued 501,000 face value 6% 5-year term bonds and were issued to yield a rate of 8%. On December 31, 2019, the entire bonds were retired through the issuance of 50,000 shares, 5 par value, currently setting at 9. The fair value of your liability is 425,000. So, what is our hierarchy? Fair value of equity. What is the fair value of equity? The fair value of equity is equal to 9 pesos per share. So, this is 50,000 times 9 pesos per share. We have 450,000. Next is the fair value of liability, 425,000, and the carrying amount of liability. So let's get the carrying amount of the liability as of 12/31/19. Okay, let's get for the fair value. Okay, I'll just amortize this one. Wait a minute. 2017, 2018, and 2019. So the carrying amount of your liability is 482,167.35. So this is the liability, 482,167.35. And this is the retirement price, 450,000. So the retirement price is lesser than your liability. If it's less, we have a gain. So how much is our gain? 32,167.35. 32,167.35. Okay? So December 31, 2019. Next, the last item, modification of terms. Okay, so what are the four? Debt forgiveness, gain agad yan. Asset swap, compare mo lang yung carrying amount ng asset na pinalit mo dun sa liability. Equity swap, anong gagawin mo naman? Bababayad mo yung equity mo. So to measure the equity, ano yung tatlong hierarchy natin? Fair value of the equity, fair value of the liability, and the carrying amount of your liability. I have no problem with your carrying amount of liability. We talked that already in our previous lesson. Next, we have your modification of terms. So what happens in a modification of term? In your modification of terms, there will be a change as to your principal amount and a change as to your interest payment. This is really, really like your impairment of your investment in bonds or your investment in debt securities or your impairment of your loan receivable. So it looks like this. So in your modification of terms under your liability, we need to look whether it is substantial or not substantial. So first, we need to compute for your gain or loss on your extinguishment. How do we compare? Again, that is your retirement price versus the carrying amount. Now, for your carrying amount here, what items are to be included? We need to include here, of course, the fees, not any accrued interest. Okay? So for the carrying amount, you need to add the accrued interest. So to compute whether it is substantial, you get first your gain or loss on extinguishment, and you compare it to your carrying amount of your liability. So gain or loss on your extinguishment divided by your carrying amount of your liability. If that is greater or equal to 10%, we call it substantial. If it's less than 10%, it is not substantial. So if it at least 10%, meaning greater or equal to 10%, substantial. If not, it is not substantial. Sir, why is it important for us to determine whether it is substantial or not substantial? If it is substantial, there is a gain or loss. While if it's not substantial, there is no gain or loss. Okay? Substantial pag 10%. Not substantial, no gain or loss. Tingnan natin. Let's have an example. Granada Company has an overdue 8% note payable to First Bank at 8 million and accrued interest of 640,000. So what is the carrying amount of our liability? 8 million. That is the fees together with your accrued interest of 640,000, 8,640,000. As a result of the debt restructuring agreement, the first bank agreed the following provisions. The principal obligation is reduced to 5 million, so principal is reduced to 7 million. Accrued interest is forgiven. The date of maturity is extended to December 31, and the annual interest of 10 million is to be paid for 4 years. So 7 million times 10%, this is the annual interest, 700,000. Okay. So you need to compare the present value of the new terms to the carrying amount. The principal is 7 million, so we use the present value of 1, 8%. Take note, di ba? Remember in your impairment, we use the effective interest rate, okay, at the date of issuance. So whatever is the date of issuance, effective interest rate, that is our discount rate. So doon sa asset nyo. Ngayon, ganun pa rin. So kung 8% yan, 8% pa rin yung gagamitin mong pang present value factor. So we use the 8% present value factor, 0.735 for your principal, and for interest, you have 3.31. So 7 million times 0.735, we have 5,145,000. And then 700,000 times 3.31, we have 2,317,000. So what is the total? The total is 5,145,2,317. We have 7,462,000. So we need to compare already. So the present value of the new terms is 7,462,000, and the carrying amount is 8,640,000. What is the difference? 8,640 less 7,462, 1,178. Okay. Gain or loss. If this is your liability, you will only change it to 7,462. We have a gain on extinguishment. So let's see if ever we can recognize that gain or loss. Sir, paano uli natin titignan? Titignan nyo kung substantial siya or not substantial. So get the gain, you divide it to the carrying amount. So the gain is 1,178. And the carrying amount is 8,640,000. What is the percentage? The percentage is 13.63. Therefore, this is substantial. Can we recognize if ever it is substantial? Yes. So how much is the gain to be recognized? 1,178,000 gain. Sir, how to compute for your interest? So whatever is the present value, you multiply it to your effective interest rate. Our present value computed is 7,462. You multiply it to your 8%, then we will get 569,960. Okay? So dito substantial siya. Paano nag-compute? Gain divided by TA. So pag may substantial, recognize the gain. So how about this one? Due to adverse economic circumstances and poor management, Tagaytay Highlands Company has negotiated a rate structuring of its 9% 6 million note payable. So the carrying amount is 6 million. There is no accrued interest, so we don't need to include any interest. The bank had reduced the principal obligation to 5 million and the interest is 13%. New interest rate is 13%, so 5 million times 13%. We have 650,000. After that, we need to get for the present value factors using the original effective interest rate. What is the original effective interest? 9%. So given naman siya. So 9%, 0.77 sa principal. Dun naman sa interest, 2.53. So let's get the total value. 5 million times 0.77 and 650,000 times 2.53. We have 5,494,500 as the present value. So it's still we have a gain here kasi ang utang natin 6 million, ibabayad lang natin is 5,494,500. So how much is our gain? 6 million less 5,494,500. We have a gain of 505,500. So let's check if ever we have substantial or not substantial. So first, we need to get for your gain, we divide to your carrying amount. So 505,500 over 6 million. What is the percentage? 8.43%. Since it is 8.43%, it is not substantial. The gain or loss is zero. So pansinin ninyo yung kanina, substantial siya, 13.63, may gain. Not substantial, no gain or loss recorded. So that's it for our compound financial instrument and debt restructuring. If you have questions, feel free to chat them.